Hello, everybody. Welcome to the Alternative Investing Club show. Today, we have a special treat. First of all, this is the first day that we're going live on all the various social media platforms. So you can see us on Facebook, LinkedIn, YouTube, and X. And we're starting our interview series and our Friday meetings also live on these platforms. In the past, it's all been done through Zoom, and so we're changing it up a little bit today. Welcome here. In the future, we're also going to be posting these meetings a little more in advance, so we can potentially have live people on the participating as well, asking questions. But today we have a special guest for you from Equity Multiple. It's Daniel Brereton. Did I say your
Perfect.
name correctly?
Yeah, right on, spot right on.
Okay. I'm very picky about saying people's names correctly, so do correct me if I get it wrong. Um, Welcome to the group here. We're going to basically hear all about equity multiple from the standpoint of a investor who's looking for commercial real estate or different types of passive private funds. And this sort of interview will help you determine if equity multiple is someone you would be interested in investing in. Or if you're interested, you can invest in them potentially through our club fund. It's also for our club fund to determine whether they're someone we'd be interested in investing with. So, from those 2 points of view, welcome, Daniel. Can you tell us a little bit about yourself in 60 seconds? And then we'll go on to equity multiple.
Sure. And Daniel, thank you for having me here. Really enjoy doing these types of interviews. Spreading the word about alternatives and just getting different perspectives on the space, especially as it evolves with some big players jumping in as well. For myself, I joined Equity Multiple a little over 2 years ago. I've been with them through a big scale up. I think a big change in the alternative investing landscape. I've got a background in alternative investments, working at other alternative investment managers, working at large wealth managers like UBS. And actually, before this, before entering the world of finance, I served in the military as well. So, traveled the world a bit, saw a lot of different perspectives. But happy to be here, focusing on real estate specifically.
Oh,
Equity multiple, yeah, it's been a very interesting ride for us.
okay. Actually, first of all, I want to ask, can you say where in the world you were stationed at your military service?
Yeah, I was unfortunate enough to be stationed in Hawaii for 4 years, so I had a nice trip there. But while I was there, I was traveling around the Pacific a bit. I went to
Okay.
Australia, Indonesia, Malaysia, Guam. So yeah, it's an excellent experience, and taught me a lot.
Oh, that's fascinating. My daughter is actually going over to the Philippines in March as part of a group that's working down there, building a building down there, and so that'll be her first experience in that area too. It's fascinating going overseas.
Sure, truly.
All right, equity multiple. So first of all, I've known about you for quite a while. I've seen a lot of your emails. I love the look of your site. It's very professional looking in terms of just the quality and the number of offerings you have up there. I personally have never really interacted with your group, even though I have received your emails for, I don't know, 5 years now, maybe. And that's not to say that I it's not to say that I haven't wanted to
Sure.
interact. I just see a lot of emails. But you've always been on my radar, and so I'm really looking forward to this interview here. Can you tell us a little bit about Equity Multiple? When did you start? What types of properties were you looking at? And can you tell us a little bit about the people who started it, or at least
Yeah,
when
of
you
course.
arrived?
Yeah, totally. So, Equity Multiple, we've been around for 9, going on 10 years, founded back in 2015. Charles Clinton and Mari Schulson are our co-founders. Charles was the one on the side. He was a private funds lawyer, worked on large deals with Blackstone and a lot of big players in the space. And, when it came down to it, he wanted to invest in these types of properties himself. He wanted to, buy a property in Brooklyn or, invest in some of these funds. And really finding it is inaccessible for a couple of different reasons. One is just the amount of capital that you have to put up for some of these deals, or you used to have to put up. And two is that it was a pretty close knit club, right? It's backroom deals or friends of friends talking, finding the capital, and you really kept to that niche. And Marius was instrumental part of this because he's got a lot of connections in the real estate industry, decades of experience, lots of really good sponsor network, and players in high net worth investments. And the two of them got together and put together this idea for a platform where you could access commercial real estate investment opportunities, which previously had only been available for high net worth and institutional investors. And I think one of the key differentiators for us is investing across the capital stack. So not just investing in equity participations in a property, even though we do a lot of those, but also senior debt, preferred equity, mezzanine debt, short-term notes. So this entire capital stack that you can build across the platform for commercial real estate. And another differentiator is just, I think, the breadth of different property types that we have. Investing in not just the core four, as I like to call them, so multi, office, industrial, and retail, but things like car washes, things like self-storage, mixed-use properties, medical office buildings, things that as the cycle develops and as things become more viable as investment opportunities become much more attractive in terms of pricing, and really, get down to it, more attractive in terms of regulation and tax advantages. We're able to bring those properties to the market and serve an investor need. So all those things add up to, I think, a really diverse platform and a lot of different types of investments, but focused on real estate. And one of the key focuses that we like to have is our in-house asset management as well. And that asset management makes us a fiduciary for the investments, holds us along the ride for the investors. We're not just making a trade and passing off to the sponsor. So investors like that. They like to just deal directly with the sponsor. But a lot of investors I've spoken to, they know that they want to have a differentiated source of wealth. They know they want to diversify their portfolio. But even if they're generally smart and they know how to invest, they still want to have someone that can help explain how these things work and help to digest that information for them.
All right, lots of interesting information there to go off of. First I'm going to start with you say that your in-house management is one of your big differentiators. Are all the properties that you invest in, do you asset manage all of them, or do you partner with other people on occasion?
So we have an in-house asset management team. We partner with sponsors who might be doing the day-to-day investments. So a lot of investors might be familiar with just a direct syndication. A sponsor is floating around a PPM or a private placement memorandum or an investor deck, and they're looking to raise money. And then you're dealing directly with them. With us, we have our real estate team who vets the sponsors, vets the property, and then we place a curated selection on our platform. And then our asset management team serves as that large LP voice on behalf of our investors. So we have typically major decision rights. We typically have majority positions in these equity offerings, and we also service the loans if we're not in equity position. So yes, every asset on our platform, every asset that we bring to the platform is going to have a dedicated asset manager focused on tracking that asset, interfacing with the sponsor, and advocating on behalf of all of our LPs as fiduciary.
Okay, so that's interesting. In terms of location, then, are you fairly location independent, or does your do you intend to invest in particular locations? And how does your asset management team focus? Do they focus on particular areas, or are they geographically dispersed?
Yeah, I guess we can unpack that in two different ways. And I guess one of the areas that I didn't mention in terms of our differentiation is that we do invest across the country. We've got assets in not just the major metros, or not just the those key states like California or Texas or New York, but some of the Sun Belt states and even some of the southern states and Midwest, where you can get some very differentiated types of real estate opportunities. Chicago, Illinois, and Madison, Wisconsin, lots of different areas. When it comes to asset management, yes, we'll typically have certain asset managers that have experience in the types of assets, but we're not geographically focused, right? We don't have an asset manager just for California assets or just for Texas assets. It really depends on what their strengths are. Someone who's done hospitality asset before probably knows how to asset manage hospitality, car washes, etc. But really, I think we've got a really talented team that has got good continuity from since we joined. I think Henry Kwong, our head of asset management, has been with the company as the first asset manager, ever. So he's seen all the assets, he knows the history, and can really help guide the team that he works with.
How many people work at Equity Multiple right now?
We're just about 40 last I counted. Yeah, and it's been a pretty lean shop. We're leaner than most of the our competitive set. But I think to boot, though, we've got feedback consistently from investors that we provide a lot of personalized service, and we're always answering the phone, always answering our emails. Even if we get a large influx, we still have that personal service that we like to do. And my team, which is myself and my analysts and one of our interns, we try to be on top of investor comms as often as possible.
That's one of the things I've admired about your group is that you do seem to be a pretty lean group, but yet you have a pretty decent amount of deal flow that comes through your platform. And so that's always been an impressive thing, to me, to be able to reach out to make those relationships with other operators, and then to go through and vet and bring on investors into those deals. It's I see. I at least in my head, I had always visualized you guys as pretty nimble and responsive people, and so I also want to just on a personal level, I don't invest in any groups that are smaller, or maybe only have two or three people working there. I like to see that there's a certain maybe mid-sized company or larger company that's associated, particularly with anything that goes into the alternative investing club fund. And so that is one of my little check boxes. Um, can you tell us a little bit about, were you always so diversified, or did you start off with a core competency, and then how did that evolve?
Yeah,
We can go right into car washes too, or other assets that you've been going into, but bring us along that timeline.
Yeah, it's interesting. One of our first assets was here in New York and Brooklyn, and I think starting local is what we focused on. Something that I really like, and what drew me over to Equity Multiple from previous companies is they've had this. We have this sort of incremental growth focus, right? We're not trying to just throw a big scatter shot into the wind and invest all across the country all at once. They started small, and even with that echoes forward for a lot of their other concepts. But starting small, starting with a single deal here in Brooklyn, starting with a couple deals on the East Coast, and then spreading out across different asset classes, and not trying to do everything all at once, but sticking to core competencies. And Marius has always been focused on new asset classes. He's a really creative guy, really interested in different types of investments and making things work in creative ways. But I think he really got tagged on this car wash thing because of the Tax Cuts and Jobs Act. The first Trump presidency tax cuts made a lot of new allowances for depreciation, a lot of new allowances for real estate, and capturing that in some interesting asset classes has been pretty compelling. And I mentioned, we do things incrementally, and even over time, we're seeing that. When we started our Ascent Income Fund, which is a debt focused income fund, we didn't again start with 10 different assets all across the country and try to blow this thing up. We started local. We started in a neighborhood that we knew here in Brooklyn. We started with assets that we knew, and again, we incrementally built it up. And now we've got 5, 6, maybe even 7 assets before the end of the year or early into Q1, where it becomes more diversified over time.
One of the things I've noticed that sets you apart from other people is you have lower minimum investment requirements. As I've been in the business now for a number of years, I've seen a lot of investors or people that initially began in this business and do well, and delight their investors and grow. A lot of times they often go towards higher and higher minimums. You'll start to see people, pushing up against 50,000, 75, 100,000, $200,000 minimums. And a lot of times the conversation is that, well, we like to deal with larger checks, or it reduces our expenses and overhead when we have to deal with fewer investors. Um, Tell us a little bit about Equity Multiple's philosophy on minimum investments.
Yeah, it's an interesting question, especially as I think a lot of alts are starting to go mainstream. A lot of these larger entrenched players, the UBSs and Blackstones and KKRs of the world, are trying to come down market. Apollo even is trying to come down market to retail investors, and we'll see what they do with minimums. My philosophy has always been to think about what the investor set that we work with is trying to do with their money. We've got wealthy people that are building up a little bit of money. Maybe they got $30,000-$40,000 built up. If you think about, okay, I just want to capture the money as fast as possible and move on, you're not thinking about the long-term interaction, the long-term relationship that you have with these investors. That sometimes on the sales side to think about that, but I've never been on the side of short-termism, and I'm seeing this as a long-term partnership with an investor. So one is, you want to help people to invest over time and realize that they can save up money and continue to access attractive offerings as the cycle evolves. Two is just the diversification lens, which is if you've got $50,000 saved up, if I set my minimums at $50,000, you're going to be put into one offering. And if that one offering doesn't meet your expectations, even if it's a positive outcome, if it just doesn't meet your expectations, it's not the ride that you signed up for, you're not going to invest in alternatives anymore. Forget about, investing with equity multiple. You're just turned off of alts forever. So if you can diversify from the beginning, and I think a lot of investors want to diversify, then you're helping people to achieve better outcomes for their portfolios. We're not in this era of ETFs and alternative investments, right? You can't just buy 500 stocks of alternatives. So we have to, incrementally get towards that. That's why we have more portfolios. That's why we have more funds. That's why we're lowering our minimums for first-time investors, $5,000, so people can get in, see how we work as a company, and build that trust along the way. One of the things that I say, kind of tongue in cheek, but also kind of seriously, is we're all a bunch of strangers on the internet. How are you going to build trust with me if you've never met me? And how do you build trust is just taking that incremental small step and seeing how we work as a platform, how you can build trust with us, and then having a nice relationship along the way.
I couldn't agree more along those lines. One issue that I often see, though, is when you get a lot of investors in a particular investment, the CPA and accounting expenses go up. How does equity multiple deal with expenses rising as they bring a lot of investors into a particular investment?
Yeah, it's interesting to think about it that way. Our administrative expenses are fairly knowable. There are times where you have an increased cost per form created, but partnering with more advanced technology firms, we've got a partnership with Agora, who have been very sharp with their tax preparation. They've just come in at a much better point where we can, not be so afraid of the volume or the cost of that volume that we have to produce in terms of taxes. It's another thing that's allowed us to keep lean is just leveraging a lot of technology along the way as well. And I don't think that the costs are overly prohibitive. There are some types of funds which can be cost prohibitive on a per capita basis. I think running a mutual fund, you have very fixed costs per person in terms of regulatory costs. But in terms of private funds, private direct offerings, it's fairly knowable what those costs are going to be, which allows us to keep it down.
Yep. You mentioned that you operate, or Equity Multiple operates in a lot of different sectors. What do you
Mhm.
see as the best sectors going into 2025, and what are you excited about?
Yeah, general disclaimer about this is not investment advice. Seek investment advice from a qualified
Yes.
professional. However, in terms of 2025 and looking forward, again, Marius Schulson, our CIO, he has been very bullish on things that are going to be positively affected by an extension of the Tax Cuts and Jobs Act provisions. So we're seeing a lot of opportunity in car washes, some preferred equity and other multi-packs of car washes. We're also seeing a lot of opportunity continued in warehouses and industrial spaces. Warehouses, as I should say, industrial spaces in general. Industrial is a very broad asset class. It's everything from large distribution centers all the way down to small multi-bay type of investment opportunities. And you can get a lot of diversity in sponsors, and especially in the middle market where equity multiple plays. You can see a lot of really great pricing power when it comes to that. The other side, the last point that I'll say of 2025 is we're probably going to see a continuation of this uptick in opportunities in like Class A markets where the pricing has started to bottom out. New York, uh, um, you know, Class A Miami, all those areas where you see a lot of really good
Phoenix. Yeah.
real estate that's coming back to market. And before the prices pick up, you're able to get in with a nice trade.
Gotcha. Um, I couldn't agree with you more actually on all three of those areas. And I want to explore something you've mentioned a couple of times here. You mentioned preferred equity, and you've mentioned that equity multiple will have rights in the deal that a lot of other single individual investors may not be able to get. Can you tell us a little bit about, and from the investor's point of view, they like to know that when they invest with somebody that there is recourse, not recourse is a technical word, but that they have the right to be able to influence the deal. And can you tell us a little bit about when you're negotiating a preferred equity deal or other types of deals, what types of rights and legal privileges do you look for that a normal LP wouldn't necessarily go in and get?
Sure. Yeah, and that's precisely it. Is that coming in with a larger check size, typically at the majority
Hmm.
on equity, you get a lot of negotiation power, and it's especially affordable in the middle market in those $5 to $50 million transaction sizes. So for us, if we're going to do an equity investment, and I'll start at the bottom of the capital stack. For an equity investment, we want to be the majority on the equity. The majority on the equity means that we have a lot of power in terms of what sort of rights, and those rights can be what are known as major decision rights, which allows us, if there's any major change in the business plan, refinances, dealing with lenders, tax abatement programs, anything that outside of the daily day-to-day operation of that business plan, other than we're going to go in, fix it up, and raise the rents, we tend to
Hmm.
have some sort of say on what happens. And what that allows us to do is it keeps the sponsor honest. It helps us to advocate on behalf of our investors, and it helps us to accelerate or slow down a business plan as needed. Everyone wants to hit right on the money for the timeline, but if there's a great opportunity to sell early, we're going to take a look at that, re-underwrite the deal, and sell. And even if the market is taking a little bit longer, in this current market, we're seeing some delayed business plans. It allows us the discretion to help the sponsor continue to extend, negotiate with lenders the proper way with a lot of expertise, and just make sure that we end up with the best outcome that we can get in our view. In the preferred equity and higher on the capital stack, preferred equity slots into the middle of that capital stack between the senior debt and the common equity. A lot of times with mezzanine or preferred equity, you go in for the higher return and the potential to get a little bit of the upside. Preferred equity, especially, you're getting that. Preferred equity, you're higher in the capital stack, so you can influence some of the decisions of the sponsor. And then in mezzanine debt, what you'll see sometimes is that if the sponsor isn't able to pay your mezzanine position, you're able to go in and actually seize the property from that sponsor. And then all the way up onto the top of the capital stack with the senior debt positions, you're really influencing the sponsor in terms of having to pay you back sooner. And on the flip side of that, the responsibility is to not be so draconian in your actions, such that you damage the long term outcome of the property. Everyone wants to be paid back their interest. Everyone wants to be paid back as fast as possible. However, I think it's much more prudent to work with a sponsor, potentially extending the loan, potentially getting a higher interest rate, if you know that they have the ability to get through a rough patch and exit in a much more favorable way.
Yeah, it's interesting when I've seen preferred equity negotiations. One of the things that is often talked about, and it's probably a double-edged sword, is the idea of contractually obligated payments.
Yeah.
When you're a limited partner, you get distributions, and they occur basically whenever the operators have amassed enough cash that they can create a distribution. They'll promise monthly or quarterly, and in hard times, they can suspend distributions. With some preferred equity arrangements, you can actually have a contractually obligated, almost more like it's a senior loan or debt payment that happens on a regular basis. And then there's the flip side of, is that good for the property, or would it be better to work with the operator in order to make sure that that cash remains within the deal, going into renovations or management and breathing life into that deal to give a higher overall growth return. So there's interesting ways that you can arrange a deal when you've got preferred equity. Do does equity multiple go even further higher or lower in the capital stack into the debt space? Do you have debt funds? Do you take first position or second position or mezzanine debt liens?
Yeah. I'll first expand a little bit on the preferred equity as well, and then you bring
Okay.
up a really great point about the fixed payments, right? Preferred equity is usually going to come with some sort of fixed dividend or current payment, and some sort of accrued payment at the end that caps your total IRR. And it can also, I think, for us, finding preferred equity that's low leverage.
Mm.
Let me back up one second. So sometimes your senior debt can get you to an LTV, a loan to value of 40, 50, 60%. And you'll have some sponsors layer on preferred equity because the lender won't give them more leverage. They can't raise enough equity and they want to juice their returns. So they layer on some preferred equity as well to get up to 80 or 90% LTV. For us, we want to find low leverage LTV, which is can give us premium pricing. So you get a higher rate of return than the senior debt just because it's lower seniority, but you're getting a leverage level which is akin to a more modest senior loan that might be placed on. So you're getting this higher return for a lower leverage level, which can be very attractive for the right project.
Yeah.
Now, for us, yes, we will go. Obviously, we go into the equity side of the capital stack. We go into preferred equity. Sometimes we have some mezzanine debt. I haven't seen as much mezzanine recently, but we are looking at a deal for mezzanine out in California. And then for senior debt, that's where we're really finding a lot of opportunities recently. In the last year and a half, we've seen senior debt, the senior mortgages, top of the capital stack, first payment priority, seen a lot of opportunities because the risk-adjusted returns, meaning you're getting equity-like returns or preferred-like returns for taking senior debt risk, have just been very, very present, especially with the wave of maturities that have been coming through in commercial real estate. A lot of sponsors are now being forced or quickly trying to refinance their properties, not being able to find the capital that they want from traditional lenders and having to resort to equity multiple. And it's not bad credits. They're not being denied traditional lending because it's a bad deal or because they're a bad sponsor. It's just the banks are pulling back capital because they're risk averse in general, or it's in a strange situation where it's just borderline for what they're looking for, where we know that working with these sponsors how it might play out, and the banks are holding back, just waiting for just past the critical point for them to come in and refinance.
Right. So that's an interesting point that you bring up with debt that's maturing right now. And I know that there are a lot of, particularly multifamily deals, but a lot of other types of assets too, where their debt is maturing. Maybe they were on a bridge loan that had a variable interest rate, or they've got high payments. They are having trouble refinancing, and some of them might be good opportunities, and others could be real landmines. How do you go through and vet when you're lending to a particular group, the opportunity and the security of the preservation of the capital?
Yeah, that's a very, very, very good question. And it's something that if everyone could do perfectly, there would be no deals left.
True.
The the underwriting on a deal, I think, is very, very important. It's not just the raw numbers that we look at when you're doing the deal. Anyone can go on Green Street or Bloomberg and whatever and pull all the numbers that you want and make a pro forma. I think the seasoned judgment of our real estate team is really great when it comes to teasing out the nuance when it comes to these deals, and the nuance when it comes to the asset class, the property type, the market, and the sponsorship and the business plan. And all those things combined together for what makes a good deal. When it comes to our lending platform, when it comes to our senior debt and our debt fund, what we like to find is situations that are bridge scenarios. So, the construction project is completed and they need to lease it up, and then that period between construction and lease up, there's that gap they need to finance, or construction's almost completed and they're rolling off one financing, etc. In those situations, you have a de-risked back end, and your front side is just getting off that period is where the new bank won't take it, or they can't
Hmm.
just get to that LTV level. We also like to look for leverage loan to value ratios or stabilized loan to value ratios that are very, very low. So between 50 to 70%, targeting around 60% LTV. And what that means is that, especially where real estate prices are now, the value of that underlying real estate would have to decline 30 to 40% before the loan became threatened to be underwater, which gives a nice cushion for us. And then last is just we like to find really strong sponsors that we can trust and that have the reputations and the experience.
Okay, great. All right. I think that's all. I need to ask you one last question, quick one, easy one. What's a book you recommend to investors who are just getting started, or maybe ones that are trying to learn those next step lessons? What book do you recommend right now for investors going into 2025?
It's a tough one because I got a whole stack for myself to read. For me, I think a denser one that really changed my view on the markets was Thinking Fast and Slow by Daniel Kahneman, Nobel laureate. It's very long and can be kind of dense, but it's a great journey in terms of thinking about investor psychology, market psychology, and the like. And if you don't have time for that one, I think, that's a tough one. No, I'll stick with
So many good ones.
I'll stick with Thinking Fast and Slow. That is my all-time favorite.
All right. How can the people of the Alternative Investing Club get in touch with Equity Multiple?
Sure. You can reach out directly to my team, ir@equitymultiple.com. My email is just daniel@equitymultiple.com. You can reach out to us on our website. We've got a chat feature. So, log on to equitymultiple.com. On the bottom right, you'll see a little icon. And you click on that, you can chat directly with Abby or me. And we respond to those within 24 hours. So, feel free to reach out to us with any questions that you ever have, and we'll be happy to answer.
All right, Daniel, thank you very much from the Alternative Investing Club for being on our show, and have a wonderful holiday season.
You as well. Thank you so much.